Good afternoon, folks. This is Joe Gordon with Gordon Asset Management. Today is Tuesday, July the 28th, and now we're going to take about 20 minutes and go through our weekly market update. As always, we have to have our regulatory disclosures here. We're not giving investment advice or tax advice or any advice other than just good information about all things going on and its impact on the markets. You can follow us on YouTube. You simply have to go to youtube.com and enter our company name, and up will pop all of these updates. You can look at them at your own leisure, including the slides, or sign up at wealthqb.com. So quickly looking at the COVID update, the one graph that we like to look at the most is really the trend in new cases in the blue line. And it's obviously going in the wrong direction, a lot of people feel, but then you look at the green line and the deaths rate is down to now 3.28% from those that have it. So clearly this is the most important data point, and this is from the perspective of many of our physician clients. That's what they're focused on. Everyone feels if you're going to test a lot more people, you're going to have people that are positive and some that just had no symptoms but were positive too. So anyway, that's the main data point here, and obviously the death rate totals have climbed above 140,000 in the U.S. and hospitalizations increased to almost 300,000 last week. So we'll keep an eye on that. There are a lot of things going on as far as vaccines and therapeutics, and you see here multiple stage 3 trials for many of the public companies going on. Last week there was a joint announcement, a government grant award to Pfizer, and I believe this is a German biotech company on memory, to produce 100 million doses of their vaccine if it proves safe and effective. Moderna says it's on track, and also even President Trump was in Raleigh-Durham yesterday visiting with a company called Novavax, I believe is how you say it. And they actually have had their stock come across everyone's screen in the last month about potential promising vaccines as well. So now, how does that translate to the markets? Well, here's international markets. So you can see year to date through yesterday, EFI, which is Europe, Australia, Far East Index, is developed markets outside the U.S., down still a little less than 8% year to date. That's the purple line here graphed. It obviously was way down back in March. Emerging markets down only 3.72 year to date. That's the orange line graph, and you can see that's going in the right direction. And then the global bond aggregate is positive, just under 6% for the year, and that probably more than anything is a function of global central banks printing money and rates falling towards zero or negative. U.S. markets, which is obviously most of us are U.S.-centric investors for the most part. Year to date, the S&P 500 as of yesterday, just barely positive, and you can see that graph by the purple here through the line up 0.04. And then you can see the NASDAQ, which is where most of your tech and biotech companies list, up 21.5% year to date. So clearly that's been the story about where money's been made. A big concern is the Russell 2000, because the Russell 2000 generally has to lead out of most every recession, and it's still down 11% year to date. And then the Barclays Aggregate Bond Index is up over 7% year to date. Again, that's a function of zero-bound interest rates with the Fed. So looking at valuations by sector, and this is something where we think is much more important to look at, where's the money being made? Now remember, as we look at quarter to date, we're talking July 1st through July the 27th data. And you can see just in this month, consumer discretionary stocks up 7.7. You can see communication services up just under 6. You can see financials actually rallying a little bit off the bottom, but they're still down almost 21% year to date. Energy's still been a pothole. It's still down 36% year to date, and that's where a lot of value investors tend to play, and that's not done well. Industrials too. So when you clearly look at sectors, you can kind of bifurcate. Well, where do value investors go? They've been in energy, materials, financials, industrials. for the most part. It's where they play some consumer discretionary. But the growth investors tend to be healthcare, communication services, technology, some consumer discretionary, some consumer staples, and also utilities tend to be in the value side as well. So the whole thing is everything's positive this quarter in the first month, but year to date you can see most every sector is positive except utilities, real estate, and the aforementioned industrials, financials, energy. So with that, we'll move on. So when you look at valuation, we talk about this every week. The S&P 500 index is trading at greater than one standard deviation above its norm, which is cause for concern. The last time that really happened to the largest degree was back when the tech bubble burst in 2000, 2002. And also leading that valuation up are the five big megatech companies, which are trading north of 30 times earnings, and they are showing the best revenue growth and also earnings growth. So balance sheets are really strong. So it's not like the last bear market when the tech bubble burst. There were a lot of companies with lousy balance sheets, high indebtedness. Not the case today. But still, the index is up. It's market cap weighted. So the five tech stocks, I believe, are pushing 25%, just at 24%, I think, yesterday. Now, looking at claims for unemployment, and again, it's hard to believe we're in a bull market rally if it is that, and you have high unemployment. So continuing claims continue to go down, currently at 16.2 million, down from 17.34 last week, and that's basically continuing claims is the orange bar graph, and you can see the downshift here. You also see the U.S. employment rate down at 11%, and obviously it was much higher, way north of 14. And then you're looking at U.S. initial claims. They actually went up a little tiny bit last week. And again, we expect this to be volatile. Why? Because a lot of companies that got PPP money, they've kept people on. They didn't furlough them because they had the money from the government to pay them. Now that money's running out, and in Washington, they're having a debate this week on the second round of stimulus checks, which I saw for people that make less than $75,000, but they still haven't resolved the House and the Senate on anything. The House wants to blow $3 trillion, the Senate only a measly $1 trillion. So looking at high frequency activity, this is really a telling chart. So you look at purchase mortgage applications still going 19% higher from down at 35%. And that's this dark blue line. So that is a good thing. If you look at the other affected areas of hospitality business, people seated diners was down 100, now down only 58. But that's probably not going to continue to be a good stat. It's volatile all over the place, the most volatile one, because some states closed again, and so the restaurants had to close. Flying traffic is still down 72% from its peak. Many on the call probably know the airlines all got $25 billion each, basically, to encourage them to keep flying empty airplanes and to keep paying their employees. That runs out September 30th. A number of airlines like United have already announced they're going to have massive furloughs unless traffic picks up. So if people don't fly, the airplane business is not a good long-term investment. Driving usage way up, total global flights down 20%. I find that one hard to believe because a lot of countries in the world say U.S. passengers can't come. And even hotel occupancy was down 70%, still down 40%. And down 40 is pretty much a break even whether they can even be sustainable business models. So let's face it, a lot of these are not coming back. You see stories every week or every other day about any of these sectors, and it's not good news. So looking at traditional inflation indicators, you can see here a lot of people don't believe, unless you're probably 55 or over, you've never had high inflation. I always like to go back and look at these charts. A lot of our younger clients and younger employees often say, is this right? Is this correct? I mean, how did you have 15% inflation? Well, if you've been around, you know what it's like, and it is an awful feeling to watch everything around you go up in paper value, but it's really worth less. Your money goes down in value every day. So when you look at inflation, there really is none yet. It doesn't reflect all this M2 increase or money supply increase yet, but still there's no inflation on the horizon. So then if you look at markets lacking breadth, we see here the NASDAQ, if you look at equal weighted indexes, it trails the cap rated by 8.7 and 8%. And again, as we've talked about before, this NASDAQ 100 equal weighted index in purple, you can see the return 12.91, but the regular NASDAQ index, which is market cap weighted, is almost 22%, which again, it's the mega tech stocks driving that performance. And they basically, the largest mega cap or largest market cap stocks continue to outperform. Everybody wants to own the mega five and some others. So it is what it is, but the rest of the markets, companies in the index are not doing nearly as well. Looking at other indexes, this is the Russell 2000. So you can see the purple, the growth level change. So it's up 5.5%. You can see the orange is the value level, still down 23. And again, a lot of the value index part has small cap financials and other possible energy related names. The growth names will tend to have more your biotech startups, even if they're not making money. They may be in phase 2 or phase 3 clinical trials. But still, small caps always tend to lead the market out of recessions. We may have had the shortest recession ever, but we need to see small caps follow, or it may just be a dead cat bounce in a bear market. So the topic this week I mentioned earlier is there's a lot more stimulus in the pipeline. Like I said, is it pick your over under? Is it $3 trillion with the Democrats in the House, or is it $1 trillion with the Republicans? Who knows? But it's at a point of insanity as far as the money printing from a lot of people that are fiscally prudent. So we'll see what comes out. I think it's already in the news. The $600 a week federal extra unemployment payment is going to be reduced. Some were saying 400. I think there was a Republican version saying 200. Treasury Secretary Mnuchin has said, at the end, it shouldn't be that people make more money. If they get 70% of what they were making prior to unemployment, that usually is a sustainable amount to pay your bills until you can find a new job. So we'll see what comes out of this, but again, it's political. Now, switching gears, what is working? What's going on? Well, if you're going to have all this money printing by our government and governments of the world, obviously this little relic metal called gold is up all-time highs this week and last week, surpassing its previous all-time high in 2011 when it peaked at $1,911 an ounce in September of that year. So it's up 25% year to date. I heard yesterday that all the millennial investors that use Robinhood are now going after gold and silver ETFs, so they'll probably continue to push it up, although I see the metal was selling off a little bit this morning before the call. So the money supply has increased 20% year to date, and that's unprecedented. And that's in this purple line, and that's all the Fed liquidity to try to help people get by who, by no fault of their own, lost their job or their business was deemed non-essential. So Goldman is forecasting 2,300 an ounce. There are a lot of other people forecasting 3,000 or more per ounce. These same people forecast these levels last time in 2011, but this scenario is a little different. The Fed wasn't printing at all in 2011 like they were or they are today. Further on gold and Goldman, you can see in the bold here, I'll let you look at it on your own, but in the bold with this record level of debt accumulation by the government, the real concern about the U.S. dollar keeping its reserve currency status is starting to emerge. And so that's going to be something to watch. It really is. So other things going on. You got the Fed Reserve meeting tomorrow. You also have the megatech CEOs going before the House Judiciary on antitrust this week. I don't know if they're speaking at the Senate as well, but that's basically venues where they each get insulted repeatedly by various members of Congress until they, ask for mea culpa, mea culpa. So, but an issue is, are they really publishers or do they just, reformat news that's in paper form. We'll see, but it is antitrust, and some people are really mad about the censorship. So if you look at consumer confidence, and here's an interesting, since we're less than 100 days before the election, it'll be probably election of our lifetimes, although a lot of people said that last time. And you can see here Republicans are more optimistic, 37%, although that's way down from 80% pre-COVID. And if you look at Democrats, they're 11% are optimistic, or those that lean Democrat. Look at the aggregate, 23%. So clearly, consumer confidence has taken it on the chin, and that's again, I think, a fallout of COVID-19 plus a lot of the rioting and looting going around the country. So what are we watching? Basically, we're watching the social unrest. We're watching the election, new stimulus stuff, inflation versus money supply expansion, market breadth. It's hard to imagine that we have so many unemployed and that the market S&P 500 is positive and Nasdaq's up 21%. Who'd have thought that? Also, the COVID-19 developments, and then corporate earnings. Are they going to snap back since so many are not even giving guidance? So with all of that, questions, please feel free to email us at info@wealthqb, or if you have the email of any of us, our professionals, feel free to do the same. Look forward to continuing the conversation. Thanks and have a super day.